Welcome to This Week in Finance, in which we cover all the exciting finance, investing, business and property news here in the UK. And if you like the video, drop one of these, as it is fantastic for the YouTube algorithm. There's an article here on This Is Money. It says here, premium bonds up prize fund rate to its highest level since 2007. The prize rate will increase to 4% from the August draw, meaning the odds of winning are the best they have been in 15 years. Although there will continue to be only two £1 million jackpot prizes, the number of the other prizes will rise. The interest rates on the NS&I pays on its direct saver and income bonds are also increasing to 3.4%. Premium bonds have obviously captured the attention of a lot of savers in the United Kingdom. If you're looking to put some money aside, risk-free location, then it does seem like a great place to put your money. I can understand the excitement of knowing you might win a jackpot at a very soon time. However, I just don't feel that there's enough value incentivizing you to do it. However, the issue with premium bonds is usually the interest rate is lower than other market savers, so why would you opt for that over, let's say, a consistent interest rate account? And my biggest real concern about premium bonds is that it's not a guaranteed interest rate. There's a chance here that if you don't have enough in premium bonds that you may not win a prize. There's an article on BBC News. Mortgage rates average 5-year fix rises above 6%. It comes after the Bank of England raised interest rates to a 15-year high of 5% last month as it tries to bring down inflation. Rishi Sunak has urged homeowners to hold their nerve over rising rates. The average rate for a 5-year fixed mortgage stood at 6.01%. The average 2-year fixed deal is now 6.47%. However, while the mortgage rates have risen rapidly, the rates on savings accounts have not gone up as fast. The average easy access savings rate is 2.45%, which is a gap of 4 percentage points. Mortgage rates increasing is obviously going to put a lot of pressure on typical households. I think something that everyone might be overlooking here is a lot of people will be coming off of their fixed mortgages in a very soon time period. That many households were currently still fixed and they had a longer term fix, let's say at the very low interest rates in the pandemic, and now obviously that's coming to become variable, let's say later on in the year, and this could be a real concern, and this could actually be the real impact to inflation. On Yahoo Finance, that JP Morgan said it sees a risk of the Bank of England that it will have to raise interest rates as high as 7% to lower runaway inflation. The central forecast is that the rates will peak at 5.75% by November, but there is a risk that elevated inflation expectations could require the Bank of England to take rates up to 7%. With these fixed rate mortgages coming unleashed in the end of the year, I think this is really going to slash spending. I think we're going to have a very troublesome winter period for the economy, not only property, but also the likes of spending in the UK economy. Now, I'm a little bit disappointed at this article here because it's very, very fear-mongering, right? It says UK house prices suffer steepest decline in 12 years. The average price of a home sold in June fell by 2.6% year on year. On a monthly basis, however, prices dipped by 0.1%. It is a correct statement based on the statistics provided, but realistically, if you already own a property and you're able to weather these increasing mortgage rates, well, it's very unlikely that this housing price change is going to impact you. For those property investors that are looking to flip a property, it may prove harder to sell it on, but I guess if you're looking for, let's say, buy-to-let landlords that could swoop in here and buy a renovated property, for the typical homeowner, I think this is a bit of a concern. I think mortgage rates increasing is obviously a scary statistic, and it's going to take up a larger percentage of an overall income and pay. On The Guardian here says that the Eurozone inflation falls to 5.5% in sharp contrast to the UK. The EU statistical agency said energy contributed to the falling headline rate. Food, alcohol and tobacco inflation slowed from 12.5% in May, but remained in double digits. The Eurostat figures contrast with the UK's annual inflation rate, which remained elevated in May at 8.7%. Quite a large concern here, the fact that we have to continue increasing interest rates in order to curb the high inflation. But because the high inflation is really becoming difficult, it's leading to a very, very big cost crisis here, that a lot of people that have got mortgages are going to experience significantly higher payments because now they're going to be paying significantly larger amounts in interest. It may mean that they'll need to remortgage and look at a longer term rate, and quite frankly, that's a terrible position to be in. And if we combine that with the prospect that property market is now likely going to cool off, especially as less people are investing in it, we may see house prices fall even more than the Yahoo Finance article suggests so far. Could be some extreme cases where individuals fall into negative negative equity, so the deposit and the value that they've put towards the value of the house has fallen below a positive number, being below zero, as obviously the valuation of the house has fallen. Now onto the Yahoo Finance trending tickers update of the week. Wizz Air saw shares rise as the low-cost carrier reported a 23% year-on-year boost in passenger numbers. Wizz Air carried 5.3 million passengers over the month, up from 4 million on the previous year. I thought there was a trend going on amongst airlines because they've identified that the cost of having staff, having free flight crews, having all of the setup, it might actually outweigh the fact of having the cost of a larger plane. But the likes of, for instance, companies like Wizz Air, where they obviously prioritize on low cost and also prioritize on the idea of very short trip destinations, I do find it a peculiar business model and not one that I would personally touch with a barge pole. Persimmon, or Pokemon, whatever you want to call it really, said that shares took a hit. This is because JP Morgan downgraded the house builder as it reiterated its cautious stance on the UK house building sector. Potential softening in sales rates from here, given the uncertainty on rates, puts the 2024 estimated volume recovery in jeopardy, while scope for affordability-led average selling prices declines still remain. Dunelm shares were downgraded. With cost of living pressures persisting, unfavourable moments in the UK, and a housing market and only a moderate store expansion story, we think that growth will be much more difficult to come by now, the broker said. Now, I do understand this. I am actually a shareholder of Dunelm. It's in my self-invested personal pension. As mortgage payments are going to represent more of an individual's household bills, well, they're going to likely be investing a lot less on furniture and decorations. That said, when there's blood in the streets, now could be the opportunity, so it's worth keeping an eye on the likes of shares of Dunelm, for example. AO World has swung to an annual profit on the back of a cost-cutting drive, with the retailer forecasting a return to sales growth in the year ahead. The group posted pre-tax profits of £7.6 million compared to the year before, where they had actually made a loss of £10.5 million. However, in that same time, revenue slumped 17%. AO World said it's confident of returning to sales growth by the end of the financial year, and it will start prudently investing in the business once again. The goods firm has just implemented a restructure at the business, which included the ending of a trial of a store-in-store format with Tesco and shutting down its business, focusing on the house building sector. A lot of businesses, especially with scale, always try to diversify their overall business offerings. So it's always a wise idea to keep an eye on other opportunities, but it does always baffle me when you've got companies that try and expand into sectors they don't understand. Diversification. It's where you've got these massive companies that start buying something that just does not fit with their brand offering. It's the equivalent of saying, okay, well, Diageo has now just invested in a loaf of bread. Why? What's the point of that? Why? What benefit would they get from this? And investors don't want that either. Investors don't want a company to diversify into different assets. So I always find it interesting when that happens. Electronics retailer CURY has revealed a dip in sales for the past year as it flagged an uncertain economic outlook. The group also said it's not paying a final dividend and would be prudent in its planning as it is concerned about the economic outlook in its main markets. CURY's reported a 38% fall in full year profit. Revenue also fell in the same time 6%. Bumper loss reported today is a bit misleading as it indicates or includes a £511 million accounting charge relating to the 2014 merger of Dixons and Carphone. It's important to note that this does not represent cash going out of the business, he added. Accounting I consider to be a dark art because it's very easy, or I say easy, well, it's legal, to actually manipulate the figures to be in the favour of your business. If I wanted to run my own business and I wanted to not pay any tax, well, I could be consistently loss-making by just simply investing more than I have. And it makes sense here why you would write this off, right? Because, hey, look, you don't want to pay more tax and you definitely have to. So the fact that they've lost £511 million, well, they've just written it off and doesn't impact the overall cash generation of the business. Well, they haven't actually lost that money. So I like to look at metrics such as free cash flow instead. Shell has warned that it would be dangerous and irresponsible to cut oil and gas production during an inflation crisis. Also warned that energy prices and bills could soar again if there was a double whammy of increased demand from China and a cold winter in Europe. The chief executive insisted that the world still desperately needs oil and gas, and moves to renewable energy were not happening fast enough to replace it. Gas division is set to be significantly lower for the past 3 months compared with the previous quarter. Oil and gas production will also be down compared with the first 3 months of the year due to a field maintenance. It also came as the company reported a £2.4 billion of write-downs for the second quarter of the year, largely due to a 1% increase in the discount rate used for impairment testing. Another example of how accounting practices are making it look like the company is performing worse than it actually is. JD JDSports here has had quite an interesting update where they are going to be paying £427 million to buy out the minority investors in its Iberian business as it progresses with expansion plans. The cash deal will be funded from its existing resources, JD said. JDSports seems to be in a fantastic financial position in which they hold very minimal debt on the balance sheet and plenty of cash. I previously made the mistake of dismissing JDSports in favour of the likes of Boohoo, for instance, because I looked at JDSports and said, well, they've got such a high valuation on a price to earnings metric. That was actually my mistake. In reality, when you look at the likes of their strong free cash flow, it looks to be as a multiple of about 10 times. House builder Gleeson has revealed it's increased its prices. It suffered a 13% drop in the number of houses sold in the year to the end of June. However, the average selling price of homes sold during the year increased by 11.3% to £186,000. The firm said that higher interest rates had affected demand, but it was hopeful about its future, having used a slower market to carry out a restructure that reduced the number of its regional management teams. The company said buyer demographics have changed markedly, with a contraction in first-time buyers and popularity rising amongst the over 55. Some 20% of buyers were people over 55, up from the 10% previously. Again, that trend is being stated in the housing market, where those that have the capital to invest are likely looking to flip the property are exactly taking the advantage of this. When we talk about my portfolio is actually down for the week. An update I have got for you is that I've been buying a little bit more shares of Sylvania Platinum, which promptly dropped by about 15% the next day. Sylvania Platinum is more of a speculative position for me. I know it's a very cyclical company that obviously mines platinum group metals. I think it's a promising business, and I think that because they have no debt, because they're well placed in the future, aside from geographical risk, I think as long as I maintain a very disciplined mindset towards this position and do not try and buy the dip because it could drop significantly more, limit the overall exposure I'll have in my portfolio and minimize that risk potential from it. But I'm not invested for the dividend here. I just think I've got a good price for the company based on the book value of its assets, and therefore think it could be a good long-term investment. Aside from that, nothing else has changed in the portfolio. Again, I hope you have enjoyed this video. I try to be as snappy as possible. If you haven't already, don't forget to subscribe because we're going to be doing this every single week. And I've actually got an email address. So if you found an interesting article that you think might add value to next week's video, then email thisweek@osborneforeman.com.